G'day YouTube and welcome back to the ASX Portfolio channel. My name's Jonathan. So today we're going to be talking about the really controversial topic, which is that most trading strategies are actually fake. Now, this is controversial, and that is why we're going to be talking about a lot of papers that statistically back this up, including research from Marcos Lopez de Prado. So let's get into it. So to demonstrate why most trading strategies are actually false, we're going to look at two things. We're going to look at a tree structure, which describes the probabilities of leading to a false discovery. Second, we're actually going to go through a real world example. We're going to be implementing a momentum-based trading strategy for Apple. Now, for Apple stock, we're going to be taking a trading range and we're going to be looking at a moving average crossover terms that actually indicate when we should buy, when we should sell. And we're going to look at this strategy and why we might actually find a false positive in terms of statistically significant result. So let's get into it. I first want to demonstrate using this paper that I found in Nature why it can be so dangerous just doing statistical testing without understanding exactly what you're doing. In hypothesis testing, it's important to remember that a p-value only measures whether our observed result can be attributed to chance. It doesn't tell us what the odds are of our actual hypothesis being correct. Now, that is an issue. The odds of having our hypothesis correct actually comes down to the strength of our observed result and also into how likely our hypothesis was being true in the first place. Now, to demonstrate that, we've got this diagram here. So if we're assessing trading strategies and we believe that our ability to be able to find a successful trading strategy is 50-50. Now, that would mean that if we were looking for significance at the 5% level, then what we would actually find is that we, 30% of the time, come up with an incorrect assumption. We find that there is no real effect. There is no real trading strategy, but we're getting a false positive. Now, if we limit this to 1%, we reduce that chance of finding a false positive down to 11%. Now, this only gets worse as we start looking for long shots. What do I mean by long shots? I mean looking for something that has a low probability of being true. So for example, trading strategies. Do you think your ability to find a profitable trading strategy is 50-50? Well, probably not, because otherwise there'd be a hell of a lot more millionaires in the world. So really, let's consider something like on this diagram that it's 1 in 20 or 19-to-1 odds against finding a trading strategy. So therefore, we have a 5% chance of finding a real trading strategy that works. If we use the 5% cutoff rule in our statistical testing, well, then we have nearly a 90% chance of finding a false positive. That's just astounding. And even if we change that to a 1% significant level, we've got a 70% chance of finding a false positive trading test. So hopefully this really helps identify that you can't just use a 5% p-value for all your hypothesis testing, because that could lead to some really bad decisions. Now, this really comes about because you need to understand how strong your result is. And you need to understand what the prior probability of actually finding a significant trading strategy or outcome is. Okay, now to help us understand, let's look at a tree diagram that Marcos Lopez de Prado has put together about this very topic. So let's say that we start off with 1,000 trading strategies that we're trying to assess. Now, let's say that the probability of us finding a successful trading strategy is 1%. Which honestly is quite high. That would mean that out of our 10,000 strategies, if they're completely uncorrelated, we would expect to have 10 trading strategies that are actually true, that do have a true alpha. That would also mean that we expect to get 990 false strategies that truly aren't correct. Now, if we look at the significance level, the rejection point of which we're going to reject the null hypothesis and say that this is a truly statistically significant result. Our trading strategy works, it has an alpha. If we leave that at the 5% level, that would mean that we're comfortable with having 50 false positives, which means that out of the 1,000 strategies, we're comfortable with having 50 strategies that we've incorrectly identified as being correct as being having had, oh, this produces alpha. If we have a power of 80%, which just means if we have 10 true strategies, what percentage of that would we like to correctly identify as being statistically significant? So 80%, so 8 out of 10, we would be finding 8 true positives. Now, if you think about that for a second, our rejection criteria at the 5% level is that I'm comfortable having 50 tests come through, trading strategies that are statistically significant, right? They're false positives. I've got 50 of them that don't work, but I've said that they do work. Now, on the other hand, I've only got 8 true strategies that I've identified under the same criteria. That's a total of 58 trading strategies. However, 50 of them have been identified incorrectly. That's an 86% false discovery rate. Now, in the financial industry, unfortunately, the false discovery rate is much higher than 86%. Why is that? Well, essentially, finding a trading strategy is very difficult. It can be even less likely than 1 in 100. Now, this may be of no surprise, but also the other big impact is that when you test things multiple times, the family-wise significant level increases dramatically from the 5% level. What do I mean by that? I mean that when we do multiple testing, we use multiple regressors, we use the same data set and we keep on investigating, looking for significance, then essentially we can lead to a higher chance of false positives. Now, there are some other smaller factors, like the fact that when we do statistical testing, there can be some underlying assumptions that are wrong. For example, we make assumptions about normality of stock distribution returns and Sharpe ratio. We make assumptions like we've got mutually uncorrelated regressors, which is completely false in finance. We have multicollinearity all the time, and that is just the relationship, the correlation between variables that we're actually trying to regress on to come up with our trading strategies. And of course, with hypothesis testing, we're assuming the normal distribution for our residual error terms. And now, using p-values and making these mistakes using multiple testing or even not understanding the strength of your test has been so widespread that the American Statistical Association came out with a paper warning of these errors. Now let's talk about multiple testing. Now, multiple testing can lead to some false discoveries. Now, this is particularly an issue when we're talking about financial data and backtesting. Why? Because financial data, essentially, it's not a true scientific method. We only have one realization of the past. It's not like the Hadron Collider where we can continue simulating and simulating and simulating and simulating under the same conditions, only changing one variable. No, we will never be able to go back in time and change what happens if this newspaper article wasn't released about Apple. So essentially we have one realization of the past. So backtesting often relies upon the walk forward method, where we're just going to test our trading strategy and assumptions over a given data set, walking forward in time. Now, one way that we can actually increase the chance of finding a true strategy is by splitting the data set and having an in sample and an outer sample. But there are problems with this too, and we'll get into that later. Now, let's assume that we're going to look at stock data from August 2016 all the way up to now. I'm going to split the data into my trading research component from August 2016 all the way up to September 2020. Then I'm going to use data from October 2020 to February 2022 to actually assess how the trading strategy does outer sample. Now, here we're going to be running into a few problems. We're going to be running into multiple testing issues and overfitting. So let's get into it. Now, with my trading strategy, I'm going to have an unsophisticated momentum trading strategy. That means that I'm going to be looking for moving average terms that cross over. When I have my fast moving average term, which only has a short look back period, when that crosses over my long look back period moving average, I want to buy. Now, how much do I want to buy? I'm actually going to set that as a variable. Given my initial capital that I have at the time, I'm going to have a risk value associated with that. That might be, I'm willing to risk 30% of my capital every time I make a trade, or 40%, or 50%. Now I'm going to have this as a variable that we can actually optimize in our trading strategy. Now I'm also going to optimize the moving average terms. Now some people would call this, oh, I'm just tuning a momentum trading strategy. I'm using a back test, I'm doing the scientific method, and I'm tuning these variables, how far I look back in the moving average terms and my risk tolerance to try and find out what tunes best for this trading strategy. Now, this is one of the biggest issues. What we're actually doing is we've got the same data set and we're actually doing multiple tests, just using different regressing terms. Now, this is incredibly dangerous because, in fact, these regressing terms are actually correlated with each other as well. So I'm going to change the fast moving average term from a period of 5 look back all the way to 20. And then I'm going to change the slow moving average term all the way from 50 to 100-day look back. I'm also going to change the risk tolerance, the amount of capital I'm willing to spend on each transaction, from 10% all the way to 100%. So I'm just going to run that over my time using Backtrader in Python. If you want to know the code, it's on my website, link in the description. So once we've run that, what I can find is that out of those 216 scenarios, those multiple tests that I ran, the highest Sharpe ratio that I found was 1.23. That led to a profit and loss of $26,400, right? Over my $10,000 of initial capital. I also have an annualized volatility of 20.53. Okay, so that's great. I've just done this test. I've tuned my trading strategy. Now, that's really good. Let's take a look at some of the statistics. Now, with that Sharpe ratio, what I want to assess is that over that given trading period, what is the chance that we've just happened onto this trading strategy that happens to be successful? Now, I'm going to do that by looking at a hypothesis test between a strategy where we have an expected Sharpe ratio of 0. So what do I mean? We have an expected return of 0, but we've got the same volatility that our trading strategy has just demonstrated. So we can simulate that out over that given time period, and we can look about where those returns actually get to. Now we've got that distribution. Now what I want to assess is how far our Sharpe ratio that we've observed is away from this probabilistic Sharpe ratio, where we can actually see that the true Sharpe ratio was actually 0. First thing to talk about here is how we can actually translate our Sharpe ratio easily in finance to a t-statistic. Now, the t-statistic is going to be used for this hypothesis testing. Now, the t-statistic in finance is super easy to calculate because we've already got it in a mathematical form of the expectations over the volatility that works for t-statistics. We just have to scale by the time period and the frequency. So we've been looking here at returns on a daily level. So what we need to do is we need to take the square root of the amount of days divided by 252. We have an annualized Sharpe ratio. So what we want to do is we want to multiply this by the square root of time in years. So now that we have that, we have our scaled t-statistic. For more information about that, please look at the paper that I'm showing on my screen, link in the description. Now for our example here, we actually have a t-statistic of 2.5. Now that leads to a p-value of 0.18. So that's 1.8%. So if we were rejecting this hypothesis, assuming a normal distribution at the 5% level, our critical t-value would be 1.6. Now, what does that mean? That means that we would reject the null hypothesis that our distributions come from the same distribution, and therefore our trading strategy works. We can actually generate alpha. We've shown that with a hypothesis test, right? Well, let's take a look at what happens when we look at our out-of-sample performance. So now we're going to be looking at the successful trading strategy with those moving average terms that we've assessed in the in-sample. Now, we're going to just run that from October 2020 through to the February 2022. Now, what we find is that we still have a positive P&L, which I'm quite surprised about. But it doesn't matter. We're not trying to cherry pick information. So this P&L has been $1,300 over that given time, and that's an annualized Sharpe ratio of 0.3, with an annualized volatility of this trading strategy of 15.4. Point 3, now that's quite a big deviation from our 1.23 that we found before. Now this could of course just be another chance result. I could have, me here as the researcher, I could have cherry-picked times in between this split of the training research data set and the outer sample data set to maximize my point that I'm getting across, right? I could have chose it so we had a huge loss in this second period, but that would be against the research principles. And that's what I'm trying to show here. What I've in fact done is something called p-hacking, and this happens with multiple testing. I, the researcher, am aware and have bias around this Apple stock price. And even though it's outer sample, I still know what that outer sample price looks like. It's not a true data generating process that I can rely upon for true statistical testing. And this can lead to some very false discoveries. So remember when I tuned the moving average terms and also my risk appetite settings before, and we found that the best look back period for the short term was 5, and that the best slow moving average look back was 50, and that my risk appetite should be 100%, meaning that I invest all the capital that I possibly can at that time into this trade. Now we found that over a given data set, but what we actually did to tune those parameters is we randomly conducted 216 tests on different regressors. I conducted 216 tests, and of course we're going to find some false positives in there. If you look at all the Sharpe ratios that I generate from those different scenarios, there's a huge range from that max that we picked out all the way down to 0.3. Now, what we're going to do to combat this issue of finding a false discovery, increasing the probability of finding a false discovery under multiple testing, is we're going to use the principles from this paper, Evaluating Trading Strategies from Campbell, Harvey, and Yan Liu. Now, in this paper, they talk about all the problems and issues of increasing your false discovery rate with financial trading strategies. They also talk about the dispute between backtesting and in-sample and outer sample and the probability of finding a false discovery. Now, this work was actually published by Marcos Lopez de Prado and colleagues in 2014. So if you're interested in that, please go and look at this paper. Now, under multiple testing, we're going to use the Buon-Ferry method, which is actually a way that we reduce our p-value, increase the t-critical value that we have to exceed in terms of our strategy Sharpe ratio to reject the null hypothesis. So how do we do this? Well, essentially in the Buon-Ferry method, we're just going to scale this or reduce it by a linear factor, which is the number of tests that we've run. Now, we've run 216 tests. So that means that our critical t-value needs to be 1 minus 5% divided by 216. Now, that t-critical value is 3.5. So that means that our t-statistic, 2.5, would have had to exceed the 3.5. So what we've actually done is just increase the threshold that our Sharpe ratio would have had to be able to prove that it is statistically different in our observed results from a trading strategy where we actually just have a Sharpe ratio of 0. So that is the whole premises of actually going about multiple testing and trying to decrease the false rate. Now, there are some issues because as we try and increase this limit, so we limit our amount of false discoveries, what we also might be doing is impacting our ability to be able to find true discoveries. And that's the power of these statistical tests. So in other words, we're trying to look at how often we lead to a false discovery, so type 1 errors, but type 2 errors is in we don't pick up a actual true trading strategy. Now, there is a much bigger risk of finding a false trading strategy, of course, because if you implement a false trading strategy, then you're not going to get any money or you might lose money. Whereas if you don't find a trading strategy that works, then obviously there's no capital loss associated with that. But of course, we want to increase our likelihood of finding a true trading strategy. Essentially, what we've found is that most trading strategies that are found are extremely unlikely to be true trading strategies that outperform, have alpha, compared to something that just has a Sharpe ratio of 0. Why is this? Because of multiple testing and because of how unlikely it is to find a true trading strategy. So when doing statistical tests, this can lead to false discoveries. So if you have any questions, I'd love to hear your response. Please put them in the comment sections below. If you like the video, go ahead and I will see you in the next one.